All right, I need to show you something that happened over the last 30 days that the financial media is not connecting for you. And if you understood what really happened and what it could mean for the next 30 days, you would not be sitting on the sidelines wondering if you missed the move. You would be seriously looking at physical silver right now. We are sitting here around $80 an ounce. And the question I keep seeing everywhere, in my comments, in my messages, all week long is this: is silver going to $200 this March? Tonight, I am going to answer that question directly. But first, I need to walk you through what happened in February, because that 40% crash is the most important part of this entire setup. And yes, before I continue, this is not financial advice. This is education. This is pattern recognition from someone who has spent years studying precious metal cycles. Do your own research. Talk to a licensed professional. But if you want to understand why the February crash may have been a setup and why $200 silver is no longer a crazy idea, then stay with me. And before we go deeper, let me know in the comments where you are watching from tonight. The United States, Canada, the UK, Australia, India, South Africa, the Middle East, wherever you are, drop your location below and also tell me this: did you hold through the February crash or did you sell? Be honest, no judgment. Because the institutions that create these crashes are very good at making retail investors panic at exactly the wrong time. And whether you held or sold may determine whether the next move builds your wealth or leaves you behind again. Now let me show you exactly what happened. On January 28, 2026, silver was trading at $116.61 per ounce. It had broken through the $100 level, a level many analysts said it would never reach. Momentum was strong. Headlines were finally starting to admit that silver was in a major bull market. Then just 7 days later, on February 5th, silver was trading at $70.90. That was almost a 40% crash in 1 week. Think about how extreme that is. An asset that took months to rise from around $50 to above $100 lost nearly half its value in less than a week. And what did the mainstream financial media tell you? They told you this was just silver being volatile. They told you this was proof that precious metals are too risky. They told you serious investors should stay with stocks, bonds, and manage portfolios. But they did not tell you why it happened. They did not tell you who benefited. And they did not tell you that this same pattern has appeared before nearly every major silver breakout over the last 50 years. Let me explain the mechanics. The silver market works on 2 tracks. First, there is the paper market. This is where futures contracts trade on the COMEX. This is where the quoted spot price is shaped by leveraged positions and financial bets. Then there is the physical market, where real silver changes hands between miners, refiners, manufacturers, dealers, and investors. These 2 markets are connected, but they are not the same. And the price you see online is the paper price. It is the price of a promise, not always the price of real metal in your hand. The institutions dominating the paper market are the bullion banks and the largest trading desks in the world, and they have used the same playbook over and over again. When silver rises too quickly, they flood the market with paper contracts. They sell futures they have no real intention of delivering. That creates the appearance of supply that does not physically exist. Then, when the price starts falling, stop losses get triggered, margin calls hit leveraged traders, and forced selling begins. That forced selling creates more fear, more selling, and a sharper drop. Then at the bottom, the same institutions that helped trigger the decline buy back their short positions for huge profits. This is not just a theory. This is a pattern many longtime precious metals analysts have documented for years. We saw it in 2011 when silver crashed from around $49 to $26 in weeks. We saw it in 2020 when silver fell from around $30 to $12 during the COVID panic before recovering again. And we saw it in February 2026 when silver crashed from $116 to $70 in 1 week. So the question is not whether these distortions happen. The real question is whether you understand them well enough to hold through them, and maybe even accumulate during them, instead of panic selling at exactly the wrong moment. Now here is why the current setup matters so much. The February crash increasingly looks like a shakeout. Weak hands were forced out, leveraged traders got liquidated, and yet the price quickly recovered from around $70 back to roughly $82. That recovery tells you something important. It tells you that underlying demand is still very strong, strong enough that even a 40% crash could not keep silver down for long. And now let us connect that to the bigger supply picture. The Silver Institute's latest 2025 supply and demand analysis projects a silver supply deficit of 117.7 million ounces. Let me make that simple. Global silver production is roughly 800 million ounces a year, so a deficit of 117.7 million ounces means demand is exceeding supply by nearly 15%. That is not a small gap. And this is not a one-time event. It is now the fifth straight year of supply deficits. Over the last 5 years, the total cumulative deficit has gone beyond 500 million ounces. So where has that missing silver come from? It has come from above-ground inventories. It has come from exchange vaults, ETFs, and stockpiles built up during years when silver prices were lower and investment demand was weaker. But those stockpiles are not endless. And when those inventories are drained far enough, the paper price will eventually have to catch up with physical reality. And when that happens, it is not likely to be a slow adjustment. It could be violent. So let me ask you something. Are you seeing higher premiums at local coin shops? Are you seeing delivery delays online? Are you hearing about tighter supply from dealers or mints? Let me know in the comments, because that physical market reality matters. Now let us connect that supply deficit to geopolitics, because this is where the situation becomes even more explosive. The Iran conflict could be the accelerant that pushes silver much higher, much faster than people expect. Iran launched a new wave of missile and drone strikes across the Gulf this week, including around Bahrain, Qatar, Kuwait, and the United Arab Emirates. These are not small events. These involve critical infrastructure in one of the most important energy-producing regions on Earth. At the same time, the United States and Israel are involved in an active military campaign against Iran, and there is no clear sign of de-escalation. President Trump said this week that Iranian officials had reached out seeking a ceasefire, but he said it was too late and that the U.S. was continuing its campaign. Iran's Foreign Minister Abbas Araghchi responded by saying Iran had not asked for a ceasefire and had no plan to negotiate. Those are not the words of parties preparing for peace. Those are the words of parties preparing for a longer conflict. And what usually happens to silver during long periods of geopolitical instability? It rises. Why? Because silver is seen as a safe haven asset. When investors see war risk, instability, and rising uncertainty, they move wealth into assets that cannot be defaulted on, frozen, or printed into worthlessness. Gold has already surged from under $3,000 in early 2025 to above $5,000 because of this exact kind of environment. And silver tends to follow gold. It usually moves later, but when it moves, it often moves harder because the market is much smaller. This conflict is not just a short-term headline. It is part of a bigger global repricing of risk. The Strait of Hormuz is under threat. A huge share of the world's oil passes through that narrow passage. Shipping insurance has jumped. Energy markets are being repriced around the possibility of a long conflict, and energy drives the entire global economy. When energy gets more expensive, inflation rises. When inflation rises, paper money loses purchasing power. When paper money loses purchasing power, hard assets tend to rise. That is basic cause and effect. And silver is still one of the few hard assets ordinary people can afford to accumulate. Now let me answer the big question directly. Can silver reach $200 this March? Let us do the math. Silver is around $82. A move to $200 would be about a 140% gain from here. That sounds huge. But remember, silver already moved from around $70 to $160 in a matter of weeks before the February crash. That was a gain of roughly 66% in less than a month. So a move to $200 would require about double that kind of percentage gain. Is it possible? Yes. Is it probable? That depends on several things happening over the next few weeks. The first factor is the Federal Reserve meeting later this month. The Fed is stuck. Inflation is still a problem, but the economy is also weakening. If the Fed cuts rates, it risks making inflation worse. If it stays tighter for longer, it risks damaging housing, stocks, and the broader economy. That means any surprise from the Fed could move precious metals sharply. If the Fed sounds more dovish, meaning easier policy ahead, silver could jump. If the Fed sounds more hawkish, meaning tighter policy for longer, silver could weaken in the short term, but that may simply become another buying opportunity. The second factor is Iran. If this conflict escalates further, especially if oil infrastructure is hit or shipping through Hormuz is disrupted, the safe haven demand for precious metals could intensify quickly. The third factor is the physical market. If supply deficits keep draining inventories and we start seeing real delivery stress on the COMEX, then prices could gap higher in a way that shocks people who still believe paper prices always reflect reality. The COMEX is believed to have only around 50 to 60 million ounces of registered silver available for delivery, while open interest represents claims on many hundreds of millions of ounces. That mismatch is obvious, and if enough contract holders ever demand delivery instead of rolling contracts forward, the exchange could face a serious problem. The fourth factor is continued central bank and sovereign buying of monetary metals, mainly gold. Central banks have been buying gold at record levels for years, and they are not doing that because they trust the current system. They are doing it because they see instability ahead, and when gold rises strongly, silver usually benefits too. So can silver hit $200 this March? The conditions are in place. The supply deficit is real. The geopolitical catalyst is active. The Fed is trapped. The physical market is tight. The only true unknown is timing. And timing in precious metals is always difficult because short-term price action can be manipulated even when the longer-term direction is clear. What I can say is that the risk-reward picture around $82 still looks very attractive. The downside may be more limited because we just lived through a brutal 40% crash and silver recovered quickly. The shakeout already happened. Weak hands were already flushed. But the upside remains very large if physical tightness grows, if geopolitical risk rises further, and if the market finally starts pricing silver based on physical reality instead of paper promises. The February crash was a test of conviction, a test of understanding. Those who understood it as a shakeout used it as an opportunity. Those who did not understand it sold near the bottom. And that raises the real question. Which group are you going to be in during the next shakeout? Because there will be another one. Silver does not move in a straight line. It rises hard, corrects hard, and then rises again. That is the nature of this market. Now let me give you some historical perspective. In 1980, silver reached $50.36 an ounce. If you adjust that price for inflation using official CPI figures, that old peak is worth roughly $190 in today's dollars. So when people talk about $200 silver like it is impossible, what they are really saying is that silver can never simply return to its old inflation-adjusted peak. That is not a strong argument. That is not fantasy. That is mean reversion. And today's setup is arguably stronger than the one in 1980. Why? Because silver now has far more industrial demand than it did back then. Solar panels, electric vehicles, electronics, smartphones, 5G infrastructure, and other modern technologies all consume silver. And that industrial demand is growing. At the same time, the supply deficit keeps building. Every year of deficit drains more inventory. Every year of deficit moves us closer to the point where the paper market can no longer hide the shortage. Now think about gold. Gold has already more than doubled, moving from under $3,000 to above $5,000 in about a year. The media covers that move constantly. They talk about central bank buying, inflation hedging, and geopolitical fear. And gold is important. But at $5,000 an ounce, it is expensive for most ordinary people to buy in meaningful amounts. Silver at $82 is still accessible. $1,000 still buys around 12 ounces of physical silver. That is wealth you can hold in your hand. Wealth outside the banking system. Wealth that cannot be frozen or erased by a digital failure or inflated away by policy. Now look at the gold to silver ratio. At gold near $5,000 and silver near $82, the ratio is around 60 to 1. Historically, over long periods, that ratio has averaged closer to 40 to 1, and during strong bull markets in precious metals, it can compress to 30 to 1 or lower, because silver tends to outperform gold on a percentage basis, so the math matters. If the ratio moves to 40 to 1 with gold still at $5,000, silver goes to 125. If the ratio moves to 30 to 1, silver goes to around 167. And if gold rises further while the ratio compresses, silver goes even higher. So yes, the math works. The fundamentals work. The setup is there. The only question is whether you have the conviction to hold through the volatility. If this analysis is helping you, subscribe to Bridgeport Finance channel and hit the notification bell, because moves in silver can happen fast, and I will be covering the Fed, Iran, and the physical market in real time. Now let me answer one final question. Is it too late to buy silver at $82? No, it is not too late. You are probably looking at the wrong time frame. If silver reaches $200 this year, buying at $82 still gives you a huge return. If silver reaches $300 over the next 2 years, buying at $82 still looks excellent. If silver reaches even higher levels during a major monetary reset, then today's price will look cheap in hindsight. The goal is not to buy the exact bottom. Almost nobody does that consistently. The goal is to understand the direction of the move and the size of the opportunity. Yes, silver crashed from $116 to $70 in February. And yes, it may crash again before reaching much higher levels. But every major correction in a bull market can become an opportunity for those who understand the bigger picture. The trend is up. The supply deficit is real. The geopolitical risk is active. The Fed is trapped. Paper currencies keep losing purchasing power. So the question is simple. Do you position yourself, or do you watch from the sidelines and regret it later? I have been accumulating physical silver for years through crashes, through volatility, and through skepticism from people who thought it made more sense to chase index funds at all-time highs. And I am still accumulating because the forces driving this bull market have not weakened. They have intensified. The February crash did not solve the supply deficit. It did not create new mines. It did not reduce industrial demand. It did not remove geopolitical risk. It did not give the Fed an easy way out. All it really did was transfer wealth from weak hands to stronger hands. The next leg higher is coming. Whether silver reaches $200 this month, later this year, or beyond that next year, the larger direction appears clear, and the people who understand that direction and who can hold through volatility may build wealth that changes their lives. So do not be the person who looks back at $82 silver and wishes they had acted. Do not be the person shaken out in the next correction because they never understood how this market works. Physical silver in your possession is yours. No counterparty risk, no custodian who can say no. No digital entry that disappears when systems fail. Real metal, real wealth, real protection in a financial system that is showing more stress by the day. This is where we tell the truth about precious metals and the wider financial system. And right now, the truth is simple. The crash was the shakeout. The recovery is the confirmation, and the next move could be the payoff. So the only question left is this: are you going to be positioned for it, or are you going to watch from the sidelines again?